This lesson is going to cover breakout trading. So, earlier in the course, you learned about the principles of Wyckoff, principles of ranges, principles of trends, and various ways in which a market can move from a range to a trend. You know about the structures, you know about accumulation and distribution and how they form. This is going to deal solely with the act of price breaking out and how to trade it. So let's look at an example. Here we have a downtrend. So it trends down, we then consolidate, and then it breaks down again. So we have potential in this area for a breakout trade. How do we actually take that? Well, let me show you. First thing you want to do, go to line chart. You need to find your swing low. So you'll remember from the earlier lessons. Swing low offers a breakout trade opportunity when it's broken. As we're in a downtrend, when this low gets broken, it's a break of structure and it gives us opportunity to trade. We see it break here, so let's break down the two ways that you can trade that. Option one is to allow the breakout to happen and then enter on a retest. So for that, you wait for an impulse candle to close with a break of structure. Let's go back to candle briefly. You can see this is an impulse candle, one black candle and then one strong black candle down. We then have a big red volume bar on the histogram, significantly elevated, well above average. The moving average is in blue. So yes, that's valid. It closes here, as you can see on the line chart. The candle close confirms we have a break of structure. We get our significant volume increase, which is the second thing we're looking for. Then, in this instance, we wait for the retest. Generally, the market will bounce after these moves and give some type of retest. Where we want to enter is at the retest of our swing low. So it broke down with volume, it then retested that level. This is where you would hypothetically enter. So you put an entry there. Now, where does your stop loss go? In this case, it goes above the interim high. You remember the interim high from the market structure lessons. That is the last high before the break of structure. It doesn't have to be the swing high. Remember, the swing high is up here. The interim high is just before the break of structure. So your stop loss goes there, and your exit will be on a sign of reversal. So you would remain in this trade until you're either stopped out or the market begins to reverse. As you'll notice on this one, the market doesn't reverse for quite some time, all the way down to here. So you could find other reasons to exit and exit down at these levels. I would exit personally in this area once it starts to range for this lengthy period of time. It's clearly not trending anymore. So you could exit somewhere in there. And in this particular example, you could have anything from a 4-hour trade to maybe a 6-hour trade using correct breakout trading form. That's option one. Option one is waiting for the retest. Option two is entering on the first confirmation. So in this example, not every breakout will give a retest. So you can have a valid strategy where it trades based on there being no retest. You have to do things slightly differently, and you really have to be careful with this because this can be easily mistaken for FOMO trading or impulse trading. It's not impulse trading if done correctly. So what do? First, you wait for the exact same thing, impulse candle to break through with significant volume increase. So we know that happens here, but at this point, we're going to do something differently. We're going to enter at the first confirmation. That means we're going to enter as soon as this high volume candle closes and the next one opens. Right on the open of the next one, we enter. Now our stop loss goes somewhere different in this one because we're taking a higher risk trade. We use tighter stop and our stop goes above the impulse candle high. The principle behind this is that this candle is supposed to be sellers in control. That means price should not be able to reach back up above the high of that candle if the sellers truly are in control with the volume they brought into the market. So you enter at the first confirmation, your stop goes above the impulse candle high, and you exit on the same sign of reversal. So again, in this instance, you would have something like a 3-hour to as much as a 4.5-hour trade. You actually see how in this example, it was better to wait for the retest. You got a tighter entry and a higher risk reward on your subsequent trade. But of course, over time, as you test this, you will realize a lot of times the breakout doesn't offer a retest and you can find a strategy that can trade either way. That is breakout trading. It works the same on the downside as it does on the upside. You wait for an impulse candle to close, confirm your break of structure. You monitor for a significant volume increase on that breaking candle. You wait either for a retest or you enter at first confirmation, depending on your strategy. You put your stop loss above the interim high or interim low, if it's the other way around, or you put it above the impulse candle high or low, and finally you exit on the sign of a reversal. The reason you enter is because of a break of structure. The reason you would exit is because of either an extended range showing lack of momentum in your current trend, or of course a market structure break, which would denote a shift of trend. That is breakout trading. Take it, test it, use it, and put it to good use.